So I am so excited to have you join us. For any of you who've ever hopped on one of our webinars in the past, you probably know that one of the things that I say and share with everyone is the fact that I have superpowers. And those came out of necessity and a high need in order to make my family be able to function and get through. It really became clear to me in about, I guess it was 1997. My kids were small, about 1 and 3. And my husband at the time, if he had $1 in his pocket, he loved to spend 2. So we had 14 different credit cards. And I would sit down at the dining room table and once I put the kids to bed and try and figure out how to pay everything with bouncing debts around from card to card and not incurring any transfer fees, not incurring any type of penalties or anything like that, so that it could keep the house afloat, buy groceries, buy, diapers and all those things that we all need at that young part in our life when we've got young kids, and not let them worry, not let them go without what they needed. I had a special power, which I developed, was the memorization of everything that we normally bought. I had 3 different stores that I utilized. I knew the price of every item by heart, so that if that store was having a sale on the day that I did my shopping, I would know if I could still get it cheaper at the other store, which sounds kind of like a trivial thing, but when you were going through the aisles, buying your groceries, and every penny counts. I took a calculator and added everything up so that I would not get to the checkout and be humiliated because I didn't have enough money to pay for it. Which leads me to the other superpower of understanding exactly how the banking system worked at the time. Now I'm going to date myself a little bit here, but you actually had 2 days before your check would pass. So I could write a check on Thursday and know that the money would be in the account by Friday when we were paid, so that when it got to the bank, there'd actually be money to cover that that transaction. So very humbling. You do not want to go to the checkout and realize you've got to put something back. You'd rather put it back on your own before you get up there and be humiliated. At that time in my life, I felt discouraged, defeated. To deal with it a lot, I would take walks. And when I would take these walks, it was my chance. The kids did not walk with me. I would do this after they went to bed, or while my husband was watching them, just to kind of clear my head. And that's where I could cry it out. I mean, as a mom, you still have all these emotions, but you don't want the kids necessarily to be in that wave of emotion that you're having. I remember one day on a walk, I looked down. I was crossing the railroad tracks, and there, nestled between the rail and a rock, was a $20 bill. I wept. I bawled, because I needed that $20 desperately that week. It was a blessing, and I was thrilled, but it also brought a realization that $20 could save me and $20 could destroy me. And that's a very sinking feeling when you start realizing that your whole world can crumble over as a little of an amount as $20. And that's where I decided that these mechanisms, tools, superpowers that I had developed in order to get by, in order to get through week to week, month to month, year to year, really needed to change and start taking on a new direction. Instead of surviving, they needed to help me thrive. It was a pivotal moment, and I made the decision to start understanding money better, how it worked, how it accumulates, and how it could better my life instead of helping me just get by. Probably the most important superpower was discernment. And with that discernment and that understanding, it was the most first most important tool to help me change my life in that direction. And I tell you all this just so you understand that this is not someone that was born with a silver spoon in their mouth and they just had to, take money out of their trust fund and their life was perfect. At our lowest moments are when we can grow the most. And our lowest moments are when we can see how we can thrive and how we can change and become a better version of ourselves. That's why we try to empower people through tidbits of knowledge so that they can refine their self to become the golden version of themselves, the better version, not change who they are, but become the better them. I no longer feel anxiety or deal with having to take a calculator through the store to make sure that I can buy my groceries. I have been blessed actually to be able to help my kids, family members, dear friends financially with things that they were going through now. And I don't say that to brag. I want you to understand that $20 struggle to now the blessing of being able to say, don't worry, boo, I got you. I can help you with this. And that is an amazing, amazing feel. I've become a better version of who I was, and not because I have money, but because I'm able to lift up others and share with others. And hopefully with this platform, what we're trying to do is broaden that outreach. As a person, we are limited to our few contacts. We want to help other women. We want to help other women become better versions of themselves because it's just not out there today. It's just not something that's freely given to women. I've been in that room where we're talking to a bank rep and he refuses to look at me. He speaks to my now husband, and my now husband will say, she's the one who asked you the question. And they nod and smile and look back at him to give him the answer. Women should not be treated that way. They should have a forum where they can get knowledge and feel comfortable asking questions. So that's my mission. And I hope that what we share today is helpful to you and we can be that forum for you. So with all that said, let me dive into what we actually are talking about today. Let me share my screen and hopefully you can see what we are looking at. Okay. The truth behind why your 401k is failing you. And I know that sounds a little harsh and a little strange. There we go. And if someone could just give me a thumbs up in the questions and answers and let me know that yes, they see the screen, that'd be fantastic. Okay, excellent. Excellent. Okay. So where I want to go now is, it sounds strong, the truth of why your 401k is failing you. But if we don't understand all of the possibilities with a 401k, we're not empowered to make the right decisions. So government controls the amount you can put in and when you can take that money out, and that those rules change periodically. Contribution limits each year are updated. For 2023, the contribution amount is $22,500. Now, I say that you can, they tell when you can take the money out also. You can take penalty-free deductions as soon as you turn 59 and a half. Now, I say penalty-free, that means there's no penalty on taking the money out. It is taxed because it's a 401k, and that's all pre-tax dollars. As of January 2023, which this has been changing, if you've been watching the Secure Acts, they've had updated Secure Acts. The RMD, which is the required minimum withdrawal, now is age 73. It was 72 and a half. Before that, it was 70, but that's changed. As of January 2023, it's now 73. Or it ups to 75 if you're born after January of 1960. And I know that sounds really confusing, but again, that was changed with the Secure Act 2.0, which is the newest version. RMD is required minimum withdrawals. And what that means is when you get to that age, even if you don't need the money out of your 401k, the government says, no, you have to start taking required withdrawals annually from your account. And the reason for that is they want their money. This has all been put in there tax-free, and it's been deferred tax growth. So when they start taking the money out, or when you start taking the money out, that's when they start getting paid. They start getting their tax on that amount. Okay. Now, here's a question. Love for you to throw this in. Again, this is something else we asked at the beginning that you throw into the question answers, the age you feel your life will go to, your life expectancy. I'd love for you to throw in questions and answers. What if you think your tax bracket will go up in retirement, go down in retirement, or stay the same? So you can put up, down, same, just one of those 3 words, because we're going to look at that later in our presentation. So I'm just curious to see where everybody's at with their thought process. So please throw that in the Q&A. So next, let's take a look at when you borrow money from your 401k, which is a possibility, and then you leave your job, the loan balance and the interest must still be paid in full. Actually, when you leave, it becomes due. So the way that works is the Tax Cuts and Jobs Act, or the TCJA, was passed in 2017. And it says that a 401k loan, borrowers must pay that back by the due date of their tax return of that year. So if you leave your job, let's say you leave your job in February, before the tax time comes for that year, you would have to have that loan and interest paid back. Okay. I know that's kind of a strange question, but I did have someone ask me, well, what if I am leaving this job? I had a 401k, I took a loan out. How does that work? So that's why I wanted to throw that in there, because I want you to understand how regulated 401ks are and the interest that is applied to that loan. Did you know that there are fees taken out normally ranging from 1.5 to 3.86%, depending on your company's 401k cumulative size? A lot of people think that there are no fees attached to their 401k. And that's one of the main things. I think that money is just growing tax deferred. There's no fees, and it's just going to be a beautiful thing. And another little thing that I didn't include in that point, I want people to understand that your 401k is directly tied to the stock market. So when the stock market goes up, you get gains. When the stock market goes down, you have losses. So if you have gains, that's fantastic. You are going to pay the fees off of the amount that you have within there. If you have losses, you still pay those fees on the amount that you have in there. But then you also have to recover what you've lost through the loss with the stock market. So hope that makes sense. And again, if you have questions as we go, throw them in the Q&A. At the end, we're going to go through those questions and try and answer everything. If we have to hop back on a slide, we can definitely do that. No worries whatsoever. Okay, tax deferred versus tax free. And how that actually looks, what it is, because we throw these terms around and sometimes people are like, yeah, I get it, but I don't get it. So I want to just kind of real easy understanding of how this works. Tax deferred is just what it says. You do not pay tax on this until you start taking money out. Tax free means we've paid the tax at the front end, so there's no tax growth in this vehicle. So we're going to use this example here, and we're going to say this is a no tax paid out contribution, and this is a tax paid out contribution. Both files, same level of contribution, same growth, everything exactly the same, so it's an apple to apple comparison, and we can get a feel for how these two things really can affect us. So the white at the top is going to symbolize the gain that you've had over the time of having this type of product. The yellow is going to represent the amount you've contributed to this product. Now, it's time to start taking money out of it. This amount, the entire vial or the entire bucket, is 100% taxed as the income because it's not been taxed prior. So now as it's withdrawn, it counts as income for you. This We paid tax on what we were contributing. So the amount of the entire payout now is tax-free money, so that when it comes back to you, it's not counted as income. Okay. So I just want you to understand that when you're looking at your tax bracket, money coming from this is going to count as income and it's going to be taxed. Money coming from this has been tax-free growth because the tax was paid at the front end as a contribution. So this money comes to you not as income. I hope that makes sense. I know that's a strange concept to kind of understand. So again, 100% contribution amount. Now, one of the other points we talked about is 401k is gambling. And we've been so programmed to understand 401k is what you have to do. You're a responsible adult, contribute to 401k. But again, enabling people to make the choices is what we do. We want you to understand a 401k can be a great way to grow money. That's true. This is representing the S&P 500, and it's from 1999 all the way up to 2019. I stopped it before COVID because there's a lot of controversy on that was an extremely abnormal year. That was craziness. So I wanted to just try and keep it nice and clean. Yes, it was. But if you study, and this is kind of a side note, if you study the stock market, it does have rhythms. Even with the craziness, it does have rhythms, and understanding those rhythms, the better you understand it, the better you can decide where to move money, keep money, and adjust in order for those things. But that's a full-time study. When I'm talking to people, most people understand the stock market to a small level as far as we understand. It grows, it falls, it has peaks and valleys. So that's what I wanted to not get into the weeds and start talking about growth of the stock market, but just understand it's normal flow. Okay. So if we look at the stock market, when the stock market goes up, there are gains. When the stock market goes down, we lose money, but we have the opportunity to regain that money. And if you have time to recover from those losses, then the stock market is a good tool. What we run into, though, is we don't always have the time for those recoveries. People who were turning, let's say right here, getting ready to turn 63, they were 63, 64 years old. They didn't have time to recapture all the money that they had lost. That's why we look at safe money options, where we have some growth from the stock market, but no losses. And that's what these columns represent. We are talking about indexed products versus and fixed rate products versus the stock market. Fixed products give you a fixed guaranteed growth. When the stock market goes down, you still gain your fixed amount. Indexed annuities or indexed universal life insurance policies give you more of a stair step. When the stock market goes up, you get some of the gain. When the stock market goes down, you gain zero or have a very small growth, like a 0.25% growth. So very minimal. So you're going basically straight across. You lose nothing of what you've gained. When the stock market goes up, you experience some of the gain. Now, if you're gaining less, because obviously this is a drastic drop and this is a more drastic rise, if you don't have the loss, you don't have to recover what was lost. Therefore, your growth begins immediately. And that's why you can experience higher growth with some of the growth versus all the growth. And I hope that makes sense. So you have a stair step system that's going to involve gains with no loss and tax-free, depending on the product, if it's an annuity or if it's an IUL. We are focusing just on IULs today because it's tax-free growth. Okay. So before we hop into that, I actually want to stop sharing and I want to take a little deeper dive into what we talked about today. One of the things was understanding what a 401k really costs you. So let me share my next screen with you. And what we are actually going to look at now is a 401k. if we are looking at a 401k, how does it actually affect you? What does it really do for growth for you over time? So I'm assuming we are a 29-year-old female who is trying to decide, do I jump into this 401k? Is this a good option for me? And what does it look like? So we're going to say that the contribution limit is $200 a month. And we're assuming a 20% tax bracket, and we're going to assume growth and those types of things. But here's what I want to jump down and look at. If we pay into this until age 70, so we've been putting away that money, and we have now contributed $123,000. We have a gross retirement income of $34,578. After taxes, our tax would be about $6,900 each year to cover that at that 20% tax bracket, which means our annual income would be about $27,663. Okay, now the cumulative taxes paid first year is going to be that $6,900. The cumulative fees and expenses paid at this point by age 70 is going to be $105,000. Okay, the death benefit is $156,000. All right, now let's jump up here and let's say, because this is a big question I get, my company matches, that's free money, right? So I should take advantage of that. And if you're not going to do anything else with your retirement plan, then it may be a yes answer there. But I want you to understand how that affects your 401k. If you're going to put more thought into retirement, then I would say there are better solutions to that question. There are better uses of your money, but let's take a look at it and let you kind of see how that works. We're going to assume that the tax bracket stays the same. Now, I had asked if people thought that their tax bracket would change or stay the same. And let me hop into the questions answers and see if anybody gave me a thought on that. I should have done that first. So let me see what we've got. So we stop sharing for a second, go to my Q&A, and okay, we think it's going to go down. All right, we're going to look at it the same to begin, and then we're going to go back and look at that and see how, if it went down, how it affects it. Okay, so let me reshare. Okay. So we should be able to see our bar graph again. If you do not see the bar graph, please throw something in question and answers real quick and let me know that we're not seeing that screen. Perfect. Okay, so we're going to leave it at 20% to begin with. Then we're going to look at how it changes if we were at a different tax bracket, because these are the numbers I really want to focus on. So we are going to say that we have a company that's going to match, and they are going to match, we're going to say $2,000 a year. You're contributing $2,400, so we're going to say $2,000. So it's a nice match. It's very significant. Sounds like a great deal. And let's go down here right away, and we're going to see that at age 70, now our cumulative expense with the match went from 105 to 176 because there's more money there. So if a fee, if it's a percent, that changes that. Let's see what it looks like at 73. At 73, the cumulative paid is the same, $27,666. But the cumulative expense, what it would be without the match, and I should have shown these numbers, but I did write them down real quick, it was $115,000. It's now $199,000. And then let's go to age 77, if I can get on there. And I'll show you why 77 in a heartbeat here, but 77, the taxes paid are going to be $55,000, where with the no match, it's 48,800. The expenses go to $219,887. Without the match, they are $118,443. And you can see the death benefit goes down to $122,000. But age 82, okay, yeah, age 82 is when you see though that your 401k paying out in that way with giving you $24,000 each year actually runs out of money by the age of 82. There's no longer going to be any funding coming from that policy or from that product. It's lasted you 12 years and there's nothing left in it to help also fund retirement. And that's with the matching. Without the matching, we actually run out of money age 77. It only lasts 7 years. And here's those numbers again. I wanted to show you. The fees I had said was with the matching. Let's see, the cumulative fee at age 70 was 105, but on the matching was 176. Age 73, it here is 115. When we did the matching, remember it was 199. And by 77, with this, it's 118. With the matching, it's $219,000. Now, this one again runs out after this year, age 77, where the other product, or with the matching, if there was matching involved, it did take you to age 82, but your final expense is going to be, for the cumulative expense and fees, $227,000. So there is a cost to having the matching funds, because remember, the matching, the fees and the expenses are figured off of the amount you have there. So let's say it's at the low end and it's 1.5. 1.5 of a higher amount is still higher being paid out. Okay. Now, how does this affect if our age, if we're at a lower tax bracket? So let's go down and say we're at a tax bracket of 15%. Our death benefit with no matching goes from 72, or it actually goes down from 77 to 76 with a lower tax bracket. Our expenditures, our fees at 76 are 110,000. Taxes paid are 46,000. So going down in taxes really doesn't help us a whole lot. But here's a myth that most people don't understand. They assume that taxes will go down as they get into a older age. And the reason it doesn't is because we've lost all of our, I'm sorry, my brain just went blank. We've lost all of the things that we can write off with our taxes. Our mortgages are normally paid. Our kids are raised, so we don't get child fee or child cuts. We don't, all of those things that we got as credits to count against our income to bring our income lower are gone. So now it's just a straight math problem. This is what I made. This is the percent I'm at. Where, how much do I have? Instead of having, this is what I made, but these are all my deductions. Now I'm at a lower income bracket. And that's why our income bracket normally lower the younger we are versus when we get older, because there are no deductions now. So, okay, I hope that wasn't terribly confusing. We're going to take this back to age 29, but now I want to introduce something else. And this is the IUL that we've been talking about. So we're actually going to go in and we're going to show the IUL, because now we've compared the 401k to itself with a matching program versus a no matching program. Now we're going to take it back with no matching program. We're going to reset everything again even. So we're at a 20% tax bracket. Growth is exactly the same, everything apples to apples. And we're going to see how these two products work against each other. The 401k example is a tax deferral. The IUL is a tax-free growth product. So that's why you're going to see some of these numbers are a little bit different at the beginning. So for instance, with a tax deferral, we are contributing $3,000, and with a tax, we're only contributing $2,400 with the IUL because the tax is coming out now versus later. Because we're not paying tax on this now, we have to pay extra because when the tax comes off, it will equal $2,400. Okay, so our annual income tax is $600. At a 20% tax bracket, if we are contributing $2,400, that means we've paid $600 in tax. Here, there's none because we have not put any tax out yet. Cumulative taxes for the first year, again, $600. Fees are going to be higher with the IUL at the beginning because it's a life product. So you're paying for that product. Fees are lower on this getting started because we don't have very much money in there. So the percentage is very low. Death benefit right off the bat. Let's say you just start both products and you die the next day. Your family's going to get $2,400 or they're going to get $76,000. And this, understand, because it's in a life product, it is not a taxable event. It is not a taxable movement of money. Okay. Now, that's 29, day one, just started. These are what the numbers look like. Now let's hop to age 70. All right, we're 70 years old now, and we have contributed $123,000 to our tax deferred product. And we've taken out our first payment, $34,578. We've had $6,900 held out for taxes, which gave us a amount or an income level of $27,663. Now, same amounts of money, but where they're at in a tax-free growth product. We've only contributed $89,400. We have paid we have an income, which is not an income. We are bringing money from our product of $27,000. So it's the exact same amount we're getting here. There is no tax withheld because it's not income. It's coming from your life product. And so this amount minus zero income is exactly the same, $27,000. Now, this is where you're going to see the cumulative taxes paid on these products to this point. Year one, $6,900 because it's year one of pulling that money out. This product, we've paid $24,600 because we've been paying the tax on the money as it's been going in. The cumulative expenses at age 70, we have paid fees and expenses of $105,000 on our 401k. On our tax-free growth product, we've paid $18,727. Our net income, again, first year, $27,000. Account balance. This account balance is $195,000. This account balance has $359,000. Death benefit, $156,000, $405,000. So this is, you die and you just took out 1 year's worth of premium because you're 70 years old, you die. This amount goes to your benefactors and it will be taxed. This amount goes to your benefactors. It's a life insurance policy. It is not a taxable movement of money. It's a death benefit. Okay, I think you're starting to see why I like these products. Okay, so let's go to, we've been using the age 73, so we're going to use that age again. We're 73. We've been utilizing this product for several years now. We're in year 3. So again, these numbers are going to stay the same. The tax now is, because we put 3 years, the annual gross retirement income, again, the same tax per year, but the cumulative amount of tax deferred is $20,554 and 0. Because again, this money's not income. This is income. The amount of cumulative taxes or cumulative fees and expenses, 115,000, 20,000. Death benefit, 82,000. You can see that that amount is going down because the money's being spent. This death benefit, $354,000. Account balance, 102,000. It's going down. This account value, 429,000. It's going up because it's still gaining, even as the money's been turned on and we're starting to pull money from it. It's still gaining through indexing and has growth. Okay. We're going to go to year 77. This is when the 401k is projected to exhaust itself. At this point in time, there are no funds after this year left to help fund your retirement. You have had a cumulative interest or taxes paid of $48,865 compared to $24,600. You have fed fees and expenses of $118,000 compared to $23,000. You have the cumulative net income was $195,000, $221,000, but the account balance now is zero. And the account balance here is $544,000. The death benefit, if you die at 77, your family gets zero. Your family gets $300,000. Again, tax-free. This is a death benefit. So we know that our 401k has exhausted itself. When would the IUL exhaust itself? You can see that the age your money will run out is never. So we had life expectancy, someone said 82. So let me go to 82. At 82, you are still getting your $27,000 and you still have a death benefit for your family of $263,000. Say you live longer than what you thought. Let's say you live to 91. You're still getting the $27,000 to help fund retirement. Your family still has $176,000 death benefit. You cannot outlive your money. This is why I love these products. And this growth is tax-free within the policy. So if you have questions on what we just went over or that, please throw them in the Q&A. I would love to take a look at those. Let me stop sharing and take a look and see if we have questions in here. Okay. The IUL seems too good to be true. How can this be allowed? That is a fantastic question. And here's how it works. With the 401k, remember I said it's directly tied to the stock market. So when the stock market goes up, you get 100% of the growth. When the stock market goes down, you get 100% of the loss. With an IUL, you experience some of the growth and some of the loss. So understand that some of the growth there's caps and depends on which product you go with. There's a lot of things behind that. And that's something that we would look at one-on-one. Which product makes the most sense for you, but you, and for your age, for your situation, yada, yada, yada. But the whole nutshell is because you're getting some of the growth and zero of the loss when it goes down, what they do is they take the money and if you look at it or think of it as a pie chart, they are giving you a portion of growth and the rest of the growth they keep. And they reinvest, the insurance company, so that there's always gaining. There's always growth. So when there's loss, because they've had substantial growth, they can afford not to pass that along to you. So that's how it can be and how it's allowed. Now, they have to, obviously, they're government regulated to make sure that the funds are always there. There's rating systems. We only work with A+ rated companies so that we don't have any worry on any of those aspects. But this is a secret that most people don't know and have not had it shared with them. And if you saw our video, we did a webinar not so long ago about how wealthy people have been using life insurance policies of different types for different things forever. I mean, clear back. And we're trying to empower people of all stages and classes to understand how it can be utilized and not just let that top, 20% of people be getting gains. We want everyone to have fair advantage, to have growth and make their money work better for them, create legacies for their family, create safe retirement systems for people, create a way for their money to grow and not be at risk, not be a situation of win or lose. It's win, win. Because remember, that money came to you tax-free. That money passes to your benefactor tax-free. Sorry, I get a little passionate there. If the money's lost in a 401k, can I make it back? Oh, that's a fantastic question. And this one has a second part question. And you said I can't lose money in IUL. Okay, I kind of touched on that, but let me recap that. With a 401k, peaks and valleys, peaks and valleys. When you lose money in your 401k, remember that, people will say, well, I lost 25%. So the market went up 25%. I regained my money. No, you didn't. If you have $100 and you lose 25% of that, you have $75 and you gain 25% back. 25% of $75 is not the same as 25% of $100. Okay. Think about that. So you really have to gain 50% back in the market in order to gain back what you lost. And I hope that's sinking in a little bit. So that's where it gets confusing. When we have a situation with the IUL where there's no loss, there's no potential loss, when the stock market goes down and you gain zero or a very minimal amount, but let's just say zero, you gain zero, you don't have to recover any ground. You had $100, market went down, you gained zero. But now when the market goes up 25%, you gain 25%. That's the perpetual growth. And that's how that grows and you don't have any setbacks. You don't have any losses. 401k, can you regain your money? Yes, you can, if you have time. Okay. Remember how when we were looking at the peaks and valleys, I said, that person who's getting ready to retire and they lose $50,000 of their 401k and they're getting ready to retire next year. Do you think that they're going to gain that $50,000 back before retirement? And the answer is very often no, they're not. They're not going to gain that back. If they have, if they're 29 and they have a $50,000 loss, then yeah, they probably will gain it back. But that's where we start looking at portfolios and decide, and that's again another area that I help people, what makes the most sense for me. And I use a rule of 100, and it's just a very simple idea. If I am 30 years old, then I can probably afford to have 70% of my portfolio at risk because I have time for it to regain growth that it loses and grow. But I need to have 30% into a safe product that has continuous growth with no chance of loss. Now let's flip that. And let's say now I am 60 years old. How should my portfolio look? Now I need 60% of my portfolio to be safe so that I don't have a possibility of loss, but I can still afford to have 40% at risk because I still have time. I still have some time. Now, that's the rule of 100. Does that mean I feel safe with those numbers? No, maybe I'm not that big of a gambler. Maybe I only feel comfortable having 20% at risk. And that's fine. It's just a rule of thumb to give you a little bit of how do I know this? Where do I start type of thing. Any other questions? Those were great questions, by the way. Any other questions? Let's see, question answers. Oh, okay. Good, Shelley. I'm glad that made sense. Excellent. Okay, so let me share this again. Know the truth about your 401k, because now you can be empowered. Let's see. Oh, I don't think I'm sharing the screen I want. Darn it. Okay. Yeah, back over here. And share. Okay, there. I think I've got knowing the truth about the ways you're saving for your future. If we know that the 401k is gambling and we understand that, then we're empowered to make the decision. Is this what I want to do with my money or do I not? Understand what free money really costs you. When people say, oh, my 401k, they match this percent, so that's free money, I should take advantage of that, right? Understand no one gets a free lunch. No one gets free money. That money is being given, but you are going to pay for it on the tax side. And the more money we have, those percentages jump, and that's where we end up paying more for that money. Understand the difference between tax-free growth and tax-deferred growth. With those three things, you're already empowered now to make a better conscious decision for yourself. Is my 401k make sense for me, or would I really like to diversify my portfolio and have something else? I hope that helped tremendously and gave you some insight. We have a free gift for you that gives some scenarios and what needs to be done, what type of things you might need. And it also has a spot where you can actually contact me and we can look at it together and we can actually put something in place for you, because that's what we want. We want people to have the right tools to fund their future the way they want it to. So you can jump on our website, which is www.bulkowskiagency.com. To accept that gift, you can scan the code. You can contact me at kelly@bulkowskiagency.com. Those are just a couple different ways, but hopefully this helps. I thank you for giving me some of your time today, and I appreciate you, and I wish you the best of growth. Oh, hey, we did launch our TikTok page. It's Finance Mama. And I would love it if you could hop on there and follow us and click to like. That would be fantastic. We have a goal. We're trying to double the number of people we have following. So if you want to be one of those people, we would love to have you. Hope that our information helped. Have a great day and be golden. Always be golden.